For more on the meetings, Yan Liang, professor of economics at Willamette University, joins us. Good to see you. Is inflation, as you just heard, still the #1 concern, I guess, impacting the global economies of the world?
Good to talk to you, Phil. I think inflation remains a very significant concern, not only because inflation itself could, reduce demand and create, a lot of hardship on the people, but more importantly, I think there's a lot of, policy, especially monetary policy, right, rate hikes that would be resulted from, this idea of fighting inflation. So I think that's why I think Guerrero mentioned that these rate hikes are going to reduce demand. And so that would then, again, depress the economy.
Over the past 12 months, when we first started dealing with inflation, the various central banks have raised rates for the vast majority of the world. In addition, we had this little sort of mini banking crisis. I think that's potentially going to have a play as well. And we've seen sort of the economies of the world get the initial bump from post-COVID, but we're starting to see a little bit of softness peeking in. I got to think that the slowdown in the economy is going to help with the inflation efforts and vice versa. So we kind of want one, but you have to have the other. It's hard to have both.
Absolutely. I think that is exactly what is behind these rate hikes, is trying to slow down the economy, especially slow down, the labor market. And you're right, with these banking crises, the banks are tightening credit, and with the higher inflation, and high interest rates, it helped to slow down the economy. So all these is going to soften demand, and therefore that would arguably help to reduce inflation. But of course, that is predicated on this idea that we're able to sustain the supply. We're able to, not to hamper supply that much that, these reduced demand, if it's coupled with reduced supply, then would have uncertain impacts, on inflation. And of course, the financial instability is a major concern as a result of these rate hikes. So again, these rate hikes may or may not help to reduce inflation, and it would come with a hefty cost.
Do you think they'll I think they will, but how do you think they will discuss the banking crisis? Because Europe kind of has a different set of banking issues as opposed to the U.S. Ours has been very regional based, specifically surrounding deposits, whereas Europe specifically, it's about sort of derivatives and sort of things that are harder, I think, for the average public to understand when you talk about taking risks. And by the way, both sides have criticized each other over the past couple of decades, but they are two different sets of problems.
Absolutely. I think you're right. All these different banking crises or financial crises or currency crises, they all have their idiosyncratic features. But I think what it's underlying and it's common, one has to do with, the lack of regulatory scrutiny. But then also it has a lot to do with, monetary policy changes. With the rate hikes, now many banks are losing values on their securities, on their long-term, government securities. And so that is inevitable, that it's going to reduce, these banks' liquidity cushion or reduce their asset values. So, despite all these differences, I think, the regulation and also changes in macroeconomic variables would inevitably have a very negative impact on these banking's health.
12 months ago, when we started to learn about the conflict in Ukraine, there was quite big panic that there would be perhaps a collapse maybe in Russia, perhaps a skyrocketing of fuel prices, or even a skyrocketing of food prices, and various different crises that come out of the conflict there. Fast forward to where we are today, the vast majority of those concerns have been alleviated, albeit food prices are still a little bit higher than they were last year. But I have to think that this is going to be part of the topic at the IMF spring meetings, is how do we get to a conclusion of this conflict so that it helps economies recover faster, which I suppose would help the overall outlook for the global economy.
That's right. I think you gave a specific mention, the factors that contributing to the slowdown of the global economy. One of them is the rising geopolitical tension, inflation, and then also the increasing fragmentation of the global economy. So she mentioned, how this Ukraine war has, heightened food crises and energy crises, and definitely that are not conducive, right, to economic recovery. And also as a result of the war and the rising global, tension, and also the U.S.-China sort of, trade frictions and technological sort of coupling, and all these, I think, take a toll on the global economy. According to the IMF's forecast, based on their simulation, actually, they've looked at, these trade fragmentation is going to cost, 7% of the global GDP, and tech decoupling is going to add another 12% GDP as a cost. Not to mention, if there are some disruptions on global capital flows, including FDI, that would add, again, additional cost. So I think, yes, there's the war that has immediate negative impacts, but then with that, right, there's also the fragmentation of the global economy that is also dragging down the global growth.
The IMF, and maybe more so the World Bank, has been traditionally tasked with funding higher risk developments and projects around the world. And where rates are today versus where rates were a year ago, they are significantly higher. And I wonder if that has an impact on the type of projects they may or may not finance, or the amount of projects that they may finance. I have to think that is a topic of discussion too, potentially.
Yes, I think it will be helpful for the IMF and World Bank and all these Bretton Woods institutions to really reflect critically on their approaches, right, of helping the developing world. I think on the one hand, with the rate hikes of advanced countries, that is definitely adding, the debt burdens of many developing countries. And for two, I think, again, the IMF and the World Bank, the approaches to helping developing countries often come with conditionalities that doesn't necessarily work well for these developing countries. Look in Argentina. I mean, the IMF has been lending, emergency lending to the tune of $56 billion in the past few, months or year. But Argentina is still really, racked heavy by the inflation and also slowdown of the economy. So I'm hoping that, yes, these institutions could reflect more critically about their approach.